Hello and welcome to this demonstration video on applying the residual operating income model. The residual operating income model is also known as the discounted abnormal operating earnings model. It's a way of valuing a company that uses operating income. So after you've reformatted your income statement and you've got your net operating profit after tax as a way of measuring a business's performance, that's the number that we'll be using as a way of valuing the business's success into the future. So our NOPAT will be So the residual operating income model looks like this. It's going to value the assets of a firm. So I've got a little subscript F to say for firm, or you could put VA for the value of the assets. So we're valuing the assets of the firm. And remember, assets equals liabilities plus owner's equity. So assets minus liabilities would equal equity. So if we're thinking about valuing a firm and investing in their shares and just interested in the value of the equity, this is valuing the firm, would have to minus off any liabilities to get the value of equity. Okay, so we'll get to that as our final step. So the value of the firm is going to be equal to our net operating assets at time period 0, our current period, so we can get that straight from our reformatted balance sheet. Then we're going to add the present value of each year in the future's residual operating income. So let's go through the steps here and we'll apply it in Excel. Step 1 is we need to forecast NOPAT and NOA. NOPAT is net operating profit after tax, and we can get that from our forecast template. And NOA, net operating assets, is also something we've got in our forecast template. So we need NOA in the current period, so the actual reformatted balance sheet that exists, and NOPAT in the future years from our forecast template, NOA in the current year, and NOA in the future years. Our second step is going to be to estimate the cost of capital for the firm. Not the cost of equity capital, but the cost of capital for the whole firm. So that's including debt and equity. And that's got this little RF notation here, cost of capital for the firm. So once we've got these forecasts and we've got the cost of capital, we've got all the parts of our formula here that we can fill in until we get to the terminal value. So let's have a look at that in Excel. So here I've got the Australian Vintage Limited spreadsheet set up, and I'll delete what I've pre-filled here so we can work through it together. I've got the template set up, and the first thing we wanted to start getting terms from this formula. So it said forecast NOPAT and NOA. Here, this line, forecast NOPAT. In 2021, I'm going to go to my forecasting tab, and I've already forecast net operating profit after tax NOPAT. So I'm going to select the 2021 NOPAT here, and I'm going to drag it along. I'm going to do 5 years. I've got a forecast NOA, so I'm going to go to my forecast tab, and I've already calculated net operating assets. So I'll get my 2021 NOA, select that, and I'll drag it along for 5 years. So I now have my NOA and NOPAT for each year. I've selected that from my forecast tab. I now need to estimate the cost of capital for the firm, this RF. In the spreadsheet, I've got it up here. The estimated cost of capital for the firm I've got as 4.87%. We'll learn how I've come up with those estimates in future topics. So step 2 is done. I've got the cost of capital for the firm. And we can see it's actually much lower than the cost of equity capital because they're borrowing money at a lower interest rate from the bank. So their cost of debt is lower than the cost of equity. The cost of capital for the firm is a weighted average between those two in this case. So step 1 and step 2 I've completed. Now I can calculate the residual operating earnings. The residual operating earnings refers to this numerator component of each term in the formula. NOPAT in year 1, so my forecast net operating profit minus the cost of capital for the firm times my starting net operating assets, or my year 0 net operating assets. So if I had net operating assets of $1 million, and based on the risk of the company I expected an 8% return, my cost of capital is 8% and my net operating assets are 1 million. I would expect, based on that, to earn a profit for the year of 80,000. If I then actually earned a profit for the year that was higher than 80,000, it means I've generated a residual operating income. The residual means it's more than expected. Or the other model name is abnormal operating earnings. We have generated an abnormally high abnormal operating income if my NOPAT is higher than my expected earnings of 80,000. So step 3 is to calculate the residual operating earnings, and it means we're going to do this formula. The NOPAT for the year minus the cost of capital times the NOA for the previous year. So let's do that step. Residual operating income in year 1. I'm going to say my year 1 NOPAT. That's what I expect to earn in year 1 from my forecast template. I'm going to then minus off my cost of capital for the firm of 4.87% and multiply by the previous year's NOA. So this is the area where students are most likely to make a mistake. I take my current year, so in year 1 I'm doing the forecast and the residual income calculation. I'm taking my year 1's NOPAT minus my cost of firm capital times the prior year's net operating assets. So I drag that along. So just to double check in year 5, I've got it okay. I didn't do the absolute referencing, so I've made a mistake there. So it's a good thing I checked. When I select this cell, I need to put the dollar signs around it so it stays referencing that one. Okay. In year 5 NOPAT minus the cost of the cost of capital for the firm times the prior year, in this case, year 4 NOA. So I've now got my residual operating incomes calculated for each year, and they're negative numbers, which isn't a good sign. That means we're forecasting that this company would be destroying value. They're generating returns less than their cost of capital. Does that make sense? Is my forecasting too negative? Well, I've estimated their cost of capital for the firm is about 4.87%. And if we look at the ratios I've calculated, in previous years, their return on equity has been less than 4% every year. So if they maintain this level of performance of only generating a return on equity of about 2 to 4%, then it makes sense that if they're only generating 2 to 4%, but they are expected to earn 4.87%, each year they're actually destroying a little bit of shareholder value by not earning a return equal to their cost of capital. Okay? And you only generate value if you earn a return higher than your cost of capital. Okay, so we've calculated the residual operating income for years 1 to 5. Our next step, calculate forecast residual operating earnings growth patterns and make a terminal value assumption. And then step 5, calculate the terminal value at time t, the terminal year. So I've done 5 years of forecasting here. So what I want to do is I want to then calculate a terminal value. I'm going to forecast or calculate my year 6 residual operating income. And this is where you need to think about what is appropriate for your firm. I'm going to use 2% growth in residual operating income. So I'm going to take my year 5 residual operating income and I'm going to multiply by 1 plus 2% to get this residual operating income. Now, when I said 2%, I was thinking for a normal company that's got positive residual operating income and it would be going up and up each year. But because it's a negative, that's actually made it more negative. So I'm going to flip the sign around, make it a minus 2%, so it starts going closer to 0. Okay, so that's just what I'm doing here. My assumption, my guess. There's no perfect way of doing this. This is just the forecast that I'm making is that after year 5, they'll start improving. They'll start getting a little bit better and going back towards a sort of normal level of returns. Okay, so I've calculated my year 6 residual operating income based on this 2% or minus 2% growth. I can now calculate my terminal value. I can say the year 6 residual operating income divided through by the cost of capital for the firm minus the growth rate. And again, because I've got this minus residual operating income and the growth here, if I put another minus sign, flip the sign around, it would be more consistent with what I think is going to happen in that their their residual operating income will head towards 0. So that will make the terminal value closer to 0 for me. Okay, they're going to destroy less value. So we've now done steps 1 to 5. Step 6, it says discount forecast residual operating earnings. The discounting part, or doing the present value calculation, refers to this denominator term of the formula. So 1 plus the cost of capital for the firm to the power of 1, present values, year 1's residual operating income. 1 plus the cost of capital for the firm to the power of 2 is the present value calculation of year 2's. And we do that for each year, including for the terminal value. So the discount factor, that denominator section of the formula, was 1 plus the cost of capital for the firm to the power of whichever amount of years we need to discount it back. Okay, so I've calculated the discount factor, 1 plus the cost of firm capital to the power of t. So in year 5, 1 plus the cost of capital to the power of 5. I can now calculate the present value of the residual operating income, and we'll do that by saying the residual operating income divided by the discount factor. What I've done here, this is the residual operating income. I calculated that on one line. A line underneath, I calculated the discount factor, and now in this current line in Excel, I'm just taking this number, dividing through by this number. Okay, the residual operating income divided through by the discount factor. So I now have the present value for each of these 5 years of residual operating income. And I also need to do the present value for the terminal value, because the terminal value was calculated in year 5. So I take the terminal value divided by the year 5. So I've now done all the way up to step 6. I've discounted all the forecast residual operating earnings, and I need to then add them to the opening NOA, this part of the formula. I've done this term, this term, and this term, and this term, but I haven't yet added NOA. So the total firm value is equal to current year NOA plus the sum of each of these present value of the residual operating income plus the present value of the terminal value. So this is the total firm value. I've now completed this formula. The value of the firm equals current year NOA plus each of the present values of the residual operating incomes and the present value of the terminal value. But it then says I need another step. If I want to figure out the firm's equity value, the firm value less book value of debt equals equity value. So if I'm trying to value a company's shares and figure out a share price, I need to do this step 7 to figure out the equity value. So the value of debt, I'm going to go to my forecasting tab because I've got it there. The actual value of debt in 2020, so the actual numbers, I've got my net financial obligations here. Net financial obligations, how much money you owe people, is going to be the debt figure that I use for 2020. So I now have my total firm value. I've got the value of debt the company has. So assets minus liabilities gives me equity. So this is my estimate of the equity value of the business. The number of shares outstanding I've received from the annual report. So the price per share, I divide through the equity value by the number of shares outstanding. And based on this model, I get a price estimate of 47 cents, and it's currently selling for 62 cents, so it would have a sell recommendation. Now remember that not investment advice, just an illustrative purpose. The terminal value makes this model very sensitive, and I haven't done a lot of research in what I actually think this terminal value would be. So it's just a very simple explanation and illustration of how to build the spreadsheet. When you're working through the spreadsheet on your own, there's some color-coded cells. So if you're unsure about what I've done in a cell, say the green cell here, the notes will explain what I've done, so why I've made these particular choices along the way. So that'll hopefully help you out. I hope that makes sense. I hope you now understand the residual operating income model. Good luck and thank you.